Hello, welcome to Any Answers Answered. Tim and I will, as previously, go through a couple of the questions on accountingWEB's Any Answers section and hopefully clear some things up for you. Our first question this month, Tim, is from the wonderfully named Heavy Metal Mike. And he would like to know when a salary sacrifice is not valid. But actually, when you look at his question in more detail, it's about a person who was being paid £6.50 an hour, not enough for minimum wage, but was also getting some accommodation benefit. And what Mike is hoping for is he can say that they got the whole figure and they've sacrificed down to the £6.50. Are you allowed to sacrifice below the minimum wage, I guess is our...
Well, only in very limited circumstances. And there are really two different threads in this particular question. The first, as you say, is to do with the national minimum wage, or as it's now called, the national living wage. And the second is to do with salary sacrifice, each of which very important areas. And as far as the first issue is concerned, the national minimum wage essentially has to be met by cash payments of earnings or wages to the worker, except that the benefit of accommodation provided by the employer can be taken into account using an offset rate that's published by HMRC. So in Heavy Metal Mike's case, what they need to do is look at the Revenue website, identify the offset rate for accommodation, and then work out what the hourly rate equivalent is for that employee. And if, when they add that to the actual wages, they do manage to hit the national minimum wage or the national living wage, then they're in the clear. But no other benefits, car benefits, anything else can be taken into account, but the accommodation benefit can.
Okay, let's just make sure we're happy with that point then. So the way you would do it is you would calculate, it's an amount per day, isn't it? So you would take 7 days worth of that, add it to, let's say, 40 hours a week of the actual payment, add those two figures together, divide by the 40 hours. If you end up over £7.20, you're fine. If you are still under £7.20, you would need to increase the wage to allow for the living wage rules.
Exactly right.
Okay.
And increasingly important these days because the Revenue are far more active in policing the national minimum wage and publicising those employers who are not meeting those payments. So it's an important area to look at. But then we move on to the salary sacrifice question, and we could open this up. It's a wider issue. There have only ever been two tax cases on salary sacrifice. One was the old Heaton and Bell, and the other, the rather more recent Reed employment case, where they paid temp employees travel expenses rather than paying them proper wages. Now, the basic point about a salary sacrifice is that if there is a reduction in an employee's salary or wages, and that reduction represents a variation of the employment contract, and typically it would be a reduction in salary or wages that represents the value of a benefit that the employee then has. It could be, for example, gym membership or health insurance, that sort of thing. As long as it's properly set up by the employer, the Revenue will be content that the wages or salary subject to PAYE will be the reduced amount, and the benefit will then be taxed in accordance with the benefit rules. Of course, it may well be that the benefit is exempt because it's a childcare voucher or it's cycle to work scheme or whatever it might be. But even if it's not exempt, the benefit may not attract primary class 1, there may be class 1A, so there could be advantages all around. But it's important to distinguish a reduction in salary, which is a variation of the contract, and a deduction from salary. So you can't have an employee simply getting the employer to pay their gym membership and deduct it from salary. That wouldn't be a proper salary sacrifice, and the Revenue would be particularly concerned over short-term arrangements. You really need to have a scheme that runs for at least, say, 12 months for the Revenue to be happy with it.
Our second question this month is from Alan Rook. And Alan has asked a question which a lot of people are asking me on courses at the moment. I don't know if you've had the same, Tim, which is to do with looking for different ways of getting money out of their property businesses with paying a little bit less tax. Now, the idea of incorporating the whole of a property business became quite popular this year with the interest rules changing, what have you. Alan's question is rather simpler. He's looking to take a property management company, effectively, which he would own with his wife. They would then have some charges made to them as a couple. And then after corporation tax, the company's left with about £10,000 of income, £5,000 each, within the new 5,000 0% dividend rate, and therefore he's saving some tax.
Yes, it's an interesting idea. What Alan is suggesting is that they set up a company. They do not transfer the properties into the company, so he and his wife continue to own the properties outside the company, but the company is a management company and effectively manages the property letting business for them. And of course, in return for that, the company charges a commission. And the suggestion is that a commission of about 15% would be suitable. Well, of course, that's very much market value in terms of property letting agents charging commissions. And if you had profit, or if you had rental income on the properties of, say, 80,000, then 15% of that would be 12,000. So 12,000 would come into the company, and the company would then pay corporation tax at 20% at the moment, and that would leave a reduced post-tax figure of 9,600, which could be paid out as dividends. Nearly 10,000, so let's round it up to the 10,000. What Alan's wondering is whether this would be a pretty neat idea, because the 10,000 could then be paid out, half to him, half to her, as dividends, and be covered by the 5,000 dividends nil rate band that each of them has. And the end result then is that they effectively get that part of what would otherwise be taxed as property rental income out of the company with just a 20% tax rate, whereas if they had it personally, it would be at higher rate. And the 20% rate, of course, is the corporation tax on that. So is it worth doing? Well, is it? I mean, in theory it works, but in practice, is it worth it for the saving that we're talking about?
So you're going to save £2,500 effectively, aren't you, if they're 45% taxpayers, 25% of the £10,000. But you've got to set up a company. You run the risk that the revenue might come and ask various questions. Particularly, I would have thought they would ask, what is this company doing? Surely if the only client of that company is in fact the couple who are the directors and shareholders of that company, we have an issue with commerciality there, I think.
I think the company would be okay, because the company would have the income being the commission that the couple will pay to the company, and the revenue will be quite happy to tax that, to corporation tax. The difficulty will be for the couple's property letting business, because they will then have the rental income of, say, 80 grand, other expenses no doubt, but they'll be claiming a deduction for the 15%, 12 grand a year, that they're paying to their own company. So the commerciality will come in their personal tax returns, where the revenue might inquire as to whether the 15% commission is genuinely deductible, given that it's not actually an arm's length arrangement, since it's an agreement between them and a company that they own. It's difficult to know whether the revenue would be that bothered, and the amounts aren't that significant if we're just looking at the 5,000.
Because we're saying it's £2,500, out of which comes the cost of running the company. Yes, it's a saving. And I often refer to this as it's a good textbook example of how this might work. But in reality, can we be bothered? And also, is it worth the effort?
Yeah, I mean, just putting a historical footnote onto it, it smacks a little bit of what we all got terribly excited about with Gordon Brown's, or was it Dawn Primerolo's, 0% starting rate for corporation tax. And initially, was it 10% on 50 grand, and then 0% on the first 10 grand? Well, the figures there were rather more attractive than they are here, where we're simply trying to get hold of the 5,000 nil rate band for dividends.
Okay, and looking through the various comments on that post, it is worth also just reminding everybody who's watching that the way that the £5,000 dividend tax works, if you like, is that the first £5,000 of taxable dividends for an individual would be covered by a 0% band, whether that be in the basic rate, higher or additional rate. It is the first £5,000 of taxable dividends that are taxed at 0%, full stop. It's not an allowance, it's not an exemption, it is taxable just at 0%.
Correct.
Hopefully useful. Do write in if you have a particular tip you would like us to cover. Do make sure you mention that on Any Answers, and we'll see you in a month's time to cover 2 more of your questions.